So moving higher. And if you annualize the April number, you're looking at about 7.2%. So moving higher. And if you annualize the April number, you're looking at about 7.2%. And oil prices are higher now than they were when those numbers were calculated. And so are probably a lot of other prices. And there's no reason to believe the prices are going to stop going up. So I think we have a serious inflation problem. And the bigger problem is the Fed is still maintaining an easing bias. And the markets are still pricing as if the next Fed move on rates is a cut, even though inflation continues to worsen. So I think the markets are really set up for a major disappointment and a big decline. And maybe even more so if the Fed doesn't hike rates. Because if it doesn't hike rates, then inflation is going to be even more out of control than if it does. But even if it does, it's too little too late to do anything about it. So this is a big problem. You can see the bond market breaking down. We're almost at a new 20-year high in long-term interest rates. I mean, we're very close. But the big problem isn't going to be the 20-year high, but when we make a 30-year high, because I think we're on the verge of a collapse. And, you know, if we get back to a 30-year high in 30-year treasuries, we're above 8%. So this is a big problem. You can see the bond market breaking down. We're almost at a new 20-year high in long-term interest rates. I mean, we're very close. But the big problem isn't going to be the 20-year high, but when we make a 30-year high, because I think we're on the verge of a collapse. And, you know, if we get back to a 30-year high in 30-year treasuries, we're above 8%. Because the 20-year high just puts us at about 5.1%. But that shows you the big gap there. You know, the interest rates are not going to stay low. And this is going to be a big problem, not just for the markets, but for the overall U.S. economy, for the federal government, because we have so much debt that needs to be financed. We can't really afford the current interest rates, let alone the much higher interest rates that we're going to get.
Yeah, for sure. I could definitely see that. So with the inflation issue, I mean, obviously gas prices are higher, fertilizers are increasing as such. Do you think this Strait of Hormuz situation, like the impacts from that is going to, I mean, that's one reason why we're seeing higher prices, right? Do you think that this is going to continue in this direction, or some people think that things are going to go back to normal at some point?
I don't even know what normal is anymore. I think we may have changed normal. But, I don't think this war is going to end anytime soon. Because I don't see that we're ever going to achieve any of the objectives that we set out to achieve, at least the way Trump laid them out. I think it's kind of a stalemate at this point where Trump is going to pretend that we have a victory. But the only way he can keep pretending is to basically not officially surrender, but just to leave things the way they are and keep making a bunch of noise. But the Iranians have already shown that they're not going to respond to those threats. And they're dug in. And I think they've already survived the worst of it. So I think, they've won in that sense that they're still there. But I think they have a lot more power now economically than they did before. They have more control in the region and more influence now. And I think we have less. And so I think that you're going to have this supply bottleneck because the amount of oil going through that strait is going to be dramatically diminished. And that's going to keep prices much higher for everybody, not just the people who are, buying oil directly from sources that travel through that body of water. But oil is a global commodity. And so if the price is going to go up everywhere. So even though we're not getting our oil through the strait, the people who were getting it are going to bid up the price of the oil that we're using. So
Peter Schiff paints a stark picture of an economy teetering on the brink, driven by persistent inflation and a Federal Reserve seemingly out of touch with reality. His analysis of rising CPI numbers, coupled with the Fed's continued easing bias while markets anticipate cuts, highlights a critical disconnect. The prediction of a bond market collapse and a potential 30-year high in interest rates exceeding 8% is a sobering thought, especially when linked to the idea that the Fed's actions are too little, too late. What's particularly concerning is the sheer scale of US debt exceeding 125% of GDP, and the hidden liabilities that push the total obligation towards $150 trillion. Schiff's assertion that the US is completely insolvent as a nation is a powerful statement, suggesting a future where either default or hyperinflation becomes inevitable. The comparison of Social Security to a giant Ponzi scheme further underscores a deep distrust in government financial management. However, while the diagnosis of inflation and debt is compelling, the proposed solution, a wholesale shift to gold and silver, while a traditional safe haven, might oversimplify the path forward. The global financial system is complex, and while gold's role as a store of value is undeniable, its price appreciation is often tied to a loss of confidence in fiat currencies, which is a gradual process. The mining stocks, as Schiff suggests, offer leveraged upside, but also come with significant company-specific and sector risks that need careful consideration. Given the dire warnings about the dollar's future purchasing power and the potential for a systemic crisis, how should an average investor balance the need for tangible assets like gold with the potential growth offered by other sectors, even if those sectors are also facing headwinds? What's the right allocation strategy in such an uncertain environment